everyone, welcome to Halftime Report. I'm Ekta Batra and with me Sonia Shenoy as well as Manglam Malu. Well, it's turning out to be a session where we are not that impacted by the Fed minutes. So yes, the view is that maybe there could be some amount of hawkishness going forward. But as of now, the Nifty is down around 0.5%. Yes, we've given up a little bit of resilience that we were showing since morning. And you can see that on the Bank Nifty as well. A lot of stocks in focus, and it seems as though what's taking place in the US markets seems to be filtering down to us. And case in point would probably be even the pharmaceutical stocks such as the likes of Cipla as well as Dr. Reddy's, all of them impacted because a lot of their US generic peers declined overnight as well. Hi guys.
Hi. It's kind of all over the place, right? I mean, I think it's not a bad outcome given that we've had such a strong run, 6-8 days of a good move. This is just some profit taking. People perhaps want to take their money and go home, and it's still hovering around that 17,850 level, so we're still about 3-4% away from all-time highs, just catching its breath after a big sprint in the last many days.
Just catching his breath. You know, you said it, Sonia, because we've seen, what, a 7-day rally as far as the markets are concerned. Globally as well has been a big rally. Currently, we're at the low point of trade, but nothing really to worry so long as we're holding that 17,800 mark, primarily because, you know, today's weekly options expiry and smart money has positioned itself between 17,800 as a support as well as 17,900, 950 as a bit of a resistance as we move closer towards that 18,000 mark. But what's heartening are the way the mid-cap stocks are performing. You know, ever since we started this rally, the mid-caps have been outperforming, and today as well, we have more stocks advancing than the ones declining, and the ones that are gaining big. We have something like Acrisil, which is up 11%, IOL Chemicals up around 8%, Jindal Stainless 8%, and broader markets too. I mean, the F&O stocks, they're doing extremely well.
They are, and you know what? I mean, many stocks are sitting at fresh highs in the broader markets, whether it's Apollo Tyres, whether it is Indian Hotels, TVS Motor, PC Jewelers. You know, a lot of these stocks have hit, SBI Life have all hit fresh 52-week highs. So the traction in the broader markets definitely continues. But Sona BLW is one stock where there was a large block deal that took place today. 10.2 crore shares changed hands. That's about 17.2% equity, which is worth 5,200 crores change hands today. And the deal happened at 510 rupees a share. Now, in this whole equity change, Blackstone, which holds about 34% stake in Sona BLW, is likely to have sold a chunk of their stake. They wanted to raise some money, so they sold about 13.6% stake, according to sources, in today's block deal. And the deal was done at 510 rupees a share. So, you know, that's why the, the stock is sort of gravitating towards that price, but large deal done in Sona BLW today.
Okay, so that's on Sona BLW. But the other one that we're tracking, in fact, is Jubilant Food, which is on our radar. The stock, in fact, has gained around 8 to 9% this week itself. Mangla, tell us more about the stock, the reason why we're seeing this kind of gain.
Well, this is just, calculated guess for Jubilant FoodWorks. It's up almost, 3% in today's trading session, 9% this week, 14% this month. And from 52-week lows, the stock has rallied about 38%. Remember, the stock had corrected a fair amount as well, about 32% from its highs. So what we're trying to guess is that our FII is buying Jubilant FoodWorks after selling it. Because you just take a look at the FII shareholding in the company. You know, in September, it was an FII favorite. We had 41% of its stake held by the FIIs. Then December, it came down to sub 40%. March, it was around 32 odd percent. In June, the FII stake fell to around 30 odd percent, sub 30 odd percent. What was common? The FIIs were selling the Indian markets lock, stock and barrel, and that reflected in the stock price as well, down 32% from highs. But now the FIIs have bought in our markets for 13 straight sessions. In fact, in last 13 sessions itself, they bought 20,000 crores. So are they looking at their old loves once again or not is the big question. For Jubilant FoodWorks, you know, the first quarter revenues and EBITDA both crossed pre-pandemic levels by almost 34 odd percent. Raw material inflation is cooling off. People are consuming a lot more. We have the MD CEO also appointed for the company so that, you know, leadership risk has gone away. And most importantly, from the peak of 75 times, the stock is trading at 56 times. So FI is entering in cheap once again, maybe.
And FI is eating the pizzas is more important, right? That's the big question.
FI is buying the shares and Indians eating the pizza. How about that?
Did you see that controversy recently where there was a mop and some toilet tools over a Jubilant pizza dough? I think it was the Bangalore Jubilant.
Yeah, I mean, I wrote to the
Domino's.
company. They said that, you know, they haven't verified it themselves. And these are just random social media pictures which you don't know whether it's that day or not. But, you know, I would trust them to be a lot more hygienic than what that picture showed. I'll be very honest.
And who are we kidding, right? I mean,
Exactly.
everyone knows what happens inside hotel kitchens. if you think that it's all going to be extremely clean and hygienic, then you're only fooling yourself, I guess.
Okay, well, anyway, Jubilant is doing well in trade, and not to mention that the FIIs have been continuously buying since the last week of July. So we'll take that with both hands along with a pizza. We'll take a short break now. But up next, more on the markets. Lot of stocks lined up in terms of news on the other side. Stay tuned.
VBM Motor is a stock in focus. The company reported a decent set of numbers overall. It was a very good revenue growth actually for the company. So as we know, they earlier used to manufacture components. Now they've also started manufacturing electric buses. Electric vehicles are currently 24% of the overall business for them, and that's been the high growth segment for them recently. Nishant Arya, who's the Vice Chairman and Managing Director of VBM Motor, joins us now to talk about that. Nishant, good afternoon. I first want to ask you, in your electric bus division, your revenues, which was about 329 crores in Q4, has fallen to 87 crores in Q1. Is there a reason for this? I mean, did you not book enough orders this time around? Is there a slowdown that you're seeing in EV buses?
No, we are not seeing any slowdown in EV buses. It's just that most of the customers always generally end up taking more deliveries in H2, second half of the year. So it is that is why we see YOY performance. That's why we end up seeing that almost all the customers are taking more delivery of buses and realizing their annual budgets in the last 2 quarters of the year.
What does your EV order book stand at right now? And how much do you intend to deliver this year?
So we have an order book of close to about 500 to 700 buses for all our different bus categories. And we are in the process of acquiring many more orders. So I think we should be delivering northwards of about 1,000 buses in this year.
So 500 to 700 buses your order book. Does that include the 200 buses that you were delivering to the Delhi government, or is it over and above that?
No, that partially includes some buses which we are yet to deliver. We have already delivered about 150 buses out of that. So about 50 buses are included in this. And rest of the orders are new orders which we are taking from different customers.
Okay, all right. So 150 of those 200 EV buses are delivered to the Delhi government. Tell us, you're quite bullish in terms of the order intake. Give us a sense in terms of the different state transport corporations that you could be winning orders from, bidding for. What can we expect?
So I think that is something we can share as things progress. So, and we have been working quite extensively with private customers also, who are quite keen on and focusing on their ESG goals and really seeing that how they're adopting
For us, break it up for us.
electric buses for the staff transportation. So we have got good orders from large airline companies like Indigo. We have been working with Celebi. We have been working with private staff operators. Even the recent buses which have gone to the Gift City, which was recently in law, the bullion exchange was recently inaugurated by the Honorable Prime Minister. So all those platforms, they are using our electric buses, and they are currently having a strong pipeline for the future.
So just back to the envelope calculation that I'm doing, Nishant, you said that you will be delivering over 1,000 buses this year. Would that mean in terms of revenue around 1,800 to 2,200 crores? Is that the rough range we're looking at from EV this year?
That is a combination. That will be a combination of our CNG and electric both.
Okay.
So approximately, you could say 50% each.
So that's so. What does that mean in terms of overall revenue for you?
No, in terms of overall revenue, because see the bus categories differ. So 9-meter, 12-meter buses are different, CNG buses are different. So we would be having our top line more than 1,000 crores this year.
Okay, top line more than 1,000 crores. Earlier you said that EVs are 24% of the overall business. You plan to raise that to about 40%. By when do you think you can do that? And what is the what does it stand at as of now?
So currently, as you see that in the last financial year, it was about 23-24%, and definitely we see that we would be going to 40% by the next financial year.
So how much of this will come through just from state government orders, you think? You told us about Delhi government, you've delivered 150 buses. Which are the other state governments where you've got fresh orders from? Any, order visibility that you have over the next 6 to 12 months from other state governments?
So we have participated in tenders across the different states. So as they mature and fructify, then I would share them on a regular basis.
Okay. Nishant, your margins were sustained, and this is at a time where, input costs are higher. 9.6% is what you delivered versus 10% year on year in Q1. Tell us what the scenario is when it comes to margins. What are you doing in terms of EV margins at this point, and what would that mean in terms of blended margins for you?
No, so margins definitely would improve as we go along, because we see that the raw material prices as well as the different key ingredients for the lithium batteries, their raw material prices are softening, and that would definitely end up enhancing the margins and the bottom line, not only for the bus business but for the component and the tooling business as well in VBM Motor. So on an overall basis, we have been working on a very frugal cost structure, even though the margins have been slightly compromised as a percentage, but in absolute terms. And otherwise, if you see, the margins are increasing multifold, almost.
What your exit rate would be for FY23? Do you have visibility at least on that? Maybe in terms of a range, will you improve to say 12 to 15%? Will you sustain between 10 to 12%? Give us an exit run rate that you're working with at least.
Yeah, we would be looking at about 11 to 12% at least.
Okay, 11 to 12% on the margins. Looking at your balance sheet, FY22 exit debt was close to around 1,400 odd crores, which had increased from about 850 crores. You've announced a fundraise plan. Can you tell us what you're looking at in terms of net debt by the end of this year? And this fundraising is coming in your bus division subsidiary, or does it come at the company level?
No, so we are evaluating different fundraising options. That's why, based on the approvals which we'll be getting in the upcoming from the shareholders. So then we would be interacting at the company level also, and for subsidiaries also. And basis that probably in the next 6 to 9 months, we would be closing on some fundraising activities for the electric bus platforms as well as a company, because the company is also expanding exponentially. The component business is also growing quite a bit.
So what's your debt breakup right now? How much of that is with you? How much of that is with the subsidiaries? What's the total debt on your books?
The total debt on the books, close to more than 50% is with the parent, and rest of it would be in the subsidiaries.
So,
okay, so you said that you're going to do some fundraising for the EV business. You've already invested 500 crores for the EV expansion, right? So over and above that,
Correct.
What will your investment be, and will it be within technology, research, manufacturing? What are you looking at?
Yeah, we would be looking at all the arenas of investing in our R&D area for new product development, as we would be launching multiple new products which are in the pipeline, and having a clear roadmap for next 2 to 3 years. Simultaneously, we are also seeing that how the company is setting up a large manufacturing capacity, so that capacity enhancement is also happening. And thirdly, we are also focusing on our e-mobility platform business, where we are participating in gross cost contracts.
And what's your overall revenue target for this year? You've given us a margin target 11 to 12%. 1,000 crore is the revenue coming into the bus division. All the other divisions together put, what would be the overall FY23 revenue?
I personally see that this year's revenue, we should be able to come close to about 4,000 crores in top line. Yeah.
All right, Nishant, we're going to let you go on that note. Thanks very much for joining in, speaking with us. That's VBM Motor. Stock up around 0.7%, has been a bit sluggish in the past couple of weeks. Nonetheless, take a short break. We have an interesting conversation on the other line.
HEL is the stock which has moved to the high point of trade with a gain of almost 5% While broader markets are doing well, we still have the Nifty holding with a cut of about 70 odd points. Led low by the pharmaceutical stocks. They've slipped after a sell-off that we saw in the US generic stocks overnight following a dispute settlement over ranitidine, which is a high-risk drug. Ekta joins in. She's walked across to the big wall to explain more. Ekta.
Well, yes, it's a down day for frontline Indian generic pharma companies such as Sun Pharma, Dr. Reddy's and Cipla. Now, while analysts and experts can't pinpoint a specific reason for the weakness today, there is a likelihood that the correction is on the back of the US generic stocks such as Teva, Perrigo, as well as Taro correcting overnight in the US markets. Analysts say the market seemed to have been spooked by a settlement on the popular antacid drug Zantac and Zantac generic, or the chemical name ranitidine. Remember, the drug was pulled out of the US in 2020 by the US drug regulators on fears that the drug contains a cancer-causing substance, NDMA. Now, the lawsuit was against some of the manufacturers of the branded and generic versions of Zantac by a 79-year-old man, Joseph Bayer, claiming that the drug, which he bought over the counter and consumed, caused his esophageal cancer. The generic pharma companies such as Teva, Perrigo, Sun, Dr. Reddy's made a combined settlement of over $500,000 with Bayer a week before it went to trial. Now, the settlement amount of the combined 500,000 odd was not that much and will be less than if the case went to trial. But the news has cropped up fears that the other similar lawsuits on ranitidine could result in a liability litigation, which could end up costing billions of dollars to resolve. Also, while litigations on generic drugs is a normal course of business, the fear is the large number of cases for ranitidine. Reports indicate there are currently more than 2,000 lawsuits in the US against manufacturers of ranitidine on allegations of it causing cancer. A US-based brokerage house that wrote on the matter indicated there is substantial uncertainty surrounding the total financial impact of the Zantac litigation. Lastly, the fear is that NDMA has also been found in other drugs in the US, such as sartan drugs, which are used to treat blood pressure, or the extended-release version of commonly used diabetes drug metformin, hence cropping up fears of similar type of litigations on those drugs. Also, the street continues to fear factors such as price pressure and factors such as the US president signing a law to lower prescription drug prices, heightening concerns around the same. Okay, well, we do have with us Aditya Khemka, the fund manager of Incred Healthcare PMS, who's joining in now to discuss this and a lot more. Aditya, hi, welcome to the show. If you could just start by explaining to us whether or not this is actually a legitimate risk when it comes to stocks such as Dr. Reddy's Sun as well as Cipla, that yes, there could be settlements which could weigh on the financials going forward.
So yeah, I mean, there is a potential risk for sure. So this is one patient who has settled for $500,000, and he had bought drugs from 4 pharma companies, including a couple of Indian companies and a couple of American companies. And because they have all settled, so they must be sharing the cost of the settlement. So I think the fear is genuine that if one patient can get $500,000 and you have more than 2,000 lawsuits, if each of those lawsuits is $500,000, then you're looking at $1 billion settlement. Right. So I think, and then if you divide it between the players, it comes to whatever, 2, 3, 4, $500 million per company, depends on what kind of the size of the settlement will be. Not all settlements will be $500,000. Some may be larger, some may be lower. So yes, it is a legitimate risk, and the risk is even bigger if this spills onto sartans. Because sartans, I mean, ranitidine is a large volume product, but sartan is also an extremely large volume product. So, if similar cases come up in sartans and then there are claims made, and again, there are settlements. So I think there is merit to say that there is a risk of cash outflow due to these settlements.
So this is coming at a time when in any case, there are other concerns, right, in the US market, whether it's pricing pressure, Biden's law for lower prescription drug prices. So all of this combined, how do you think it could impact the earnings? I mean, will there be a major impact on earnings for Indian pharma companies?
So 3 things you said, right? So first is the settlements. So the settlements do impact earnings, but generally the street discounts them as one-off impact, and we don't extrapolate that impact to future earnings. So that ideally should not impact the P&L that much. It can impact the stock price to the extent that there is a one-time cash outflow, but it doesn't have a long-lasting huge impact on the market cap of companies that you discussed. On the second side, you're talking about the Biden law for lower prescription drug prices in the US. That is largely relevant for innovative pharma companies because you have to understand that the US pharma market, 90% by value is branded, but only 10% volume is branded. Whereas, it is 90% volume is generic, but only 10% value is generic. So any law that the US lawmakers pass around pricing in the US is generally to contain the value of the branded portfolio, the innovator portfolio, and not the generic portfolio. Whereas the Indian pharma companies are largely on the generic side. Only a couple of Indian pharma companies have presence on the innovator side in the US market. So therefore, the Biden piece will probably not have any impact at all on the Indian pharma companies' US business.
I just wanted to interrupt you because of paucity of time, and I just wanted to ask you that this NDMA issue seems to be cropping up for other drugs as well, say the sartan portfolio, metformin. So there is a risk that this kind of civil lawsuit could continue for those set of drugs as well. So do you think that this is going to be a long drawn affair? This is something where we're going to keep getting news pieces over a period of time and then stocks will continue to react? Something that we've seen in the past with, say, the pricing issue, the generic pricing issue and the settlements there.
Yeah, so it's hard to say whether this will happen with other drugs or not, but these things generally, US being a very litigious society, these things keep happening in the US. So I cannot rule out that possibility that it will recur. Having said that, this is not something that we as analysts or fund managers can build into our expectations. It can only result in lowering of multiples for businesses which are highly US generic oriented, because that tends to be a business which is volatile in terms of pricing, litigations, overheads. So, with the portfolio that I manage, the Incred Healthcare portfolio, we are significantly underweight the US generic business because these are the risks that the business comes with, and the risk reward is just not worth it.
You preempted my question, Aditya. In a situation where there are so many headwinds going ahead, etc., especially from the US side of things, how does one play this from an investment standpoint? I mean, there are a multitude of options across many sectors, but if you had to, make a pitch for the pharmaceutical space, how would you play that, and what would be the broader themes, if you can, maybe some stocks as well?
Sure. So you play India. You don't play the US at all. You don't have to. So basically, India is a market where these risks are significantly lower or absolutely absent for that matter. So you play companies which have a majority of their cash flow, profit, and balance sheet engaged in the India business. You play hospitals, you play diagnostics, you play API manufacturing, make in India, China plus one. You play these buckets. So again, the portfolio that I manage, we have 50% of the portfolio in companies that are India oriented. We have 20% of the portfolio in companies that are API chemical manufacturers. We have 20% of the companies which are India hospitals. We have 10% in diagnostics and cash put together. So we have literally very, very insignificant weight in companies which are US oriented because of the risks that are coming out in the US business and the lack of pricing power in the business. So we don't buy these stocks just because they're large caps. We don't care. We want to buy those companies which can give us sustainable high ROE, sustainable cash flow, sustainable growth. And this is the pocket that you need to play. Hospitals, diagnostics, make in India, China plus one, and branded generics in India.
Okay, just one final question then. Since you have a presence in the diagnostic space, there's a lot of pressure there in terms of competition now. So many new participants coming in, so many e-commerce players as well. Do you think the listed diagnostic companies could see some more pressure? They've already fallen quite a bit this year.
Yeah. So I think the short answer is no, simply because 85% of the diagnostic market is actually unorganized. It's mom and pop stores. 15% of the market is organized. So if there is increased competition in the organized space, I doubt if those competitors will go after the 15% share of the existing organized players, because they will have to bleed, they will have to compete hard to take share from these organized players. For them, the low-hanging fruit is the 85% unorganized share. So you go after them first. That's the low-hanging fruit. That is the area where you can easily get share at lower customer acquisition cost. So I don't feel the recent reaction of diagnostic stocks is related to competition. It is more related to the subsiding of COVID volumes. So I think because the last year these companies did a lot of COVID tests, and this year those tests are not recurring, the financial performance is not looking optically good. It's looking weak. And whenever that happens, these stocks tend to be volatile. So I think that's just what we are noticing. And people are unnecessarily correlating it with the competition. The competition has got nothing to do with it.
Oh, okay, all right. Aditya, that discussion can go on for another time, but I just had a quick last question with regards to US generics. You didn't mention, a company such as Sun Pharma has differentiated itself entirely. It's just focused on specialty in the US, and it can't be clubbed as a pure generic company anymore. That wouldn't enthuse you either?
So look, I am interested in the specialty business in the US because it's a very interesting business. But then there is a valuation angle to it as well. You have to understand any specialty drug in the US has a maximum 15-year patent life, right? So the revenues or the earnings from that drug cannot trade at more than 15 times because the revenue will not exist after 15 years. It will basically go generic and the innovator will lose a share, significant amount of a share. So yes, that does intrigue me at a particular valuation, at a particular time. That business model can be looked at. So look at the valuations of Pfizer, Lilly, AbbVie, right? And then compare it to some companies that you mentioned, which are doing specialty from India. There is no sync in those two valuation multiples, which tells me that one of these markets is wrong. And my call is that the Indian investor hasn't really decoded how to value specialty yet. And the Western investors are used to valuing specialty for donkey's ages now. So they have got the formula right in my view.
Okay, Aditya, we'll leave it at that. Thanks a lot for stopping by and speaking to CNBC-TV18. So that's from the pharma stocks. Lots happening in the auto space as well, by the way. Nitin Gadkari has just launched Ashok Leyland's electric double-decker bus in Mumbai. So that is a big launch. There's another big launch taking place from the Maruti stable, where they are going to just in moments from now be launching the new Alto K10 in the hatchback segment. So we'll keep tracking that one as well for you. As we take a break, a quick reminder for our viewers. It's that time of the year again. Money Control Pro's Financial Freedom offer is back, and this comes with added benefits. So get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits only on the Money Control app or website.
Focus on some news then. The Reserve Bank of India has released a discussion paper on aspects related to charges in payment systems and various payment instruments. Our colleague Ritu Singh joins in with more details on this story.
Well, yes, RBI has released a discussion paper on the charges levied in payment systems, but importantly, it has not taken a stance on these just yet. What it has done is raise questions on a wide range of issues and sought public feedback on them by the 3rd of October. Broadly, these questions ask if digital payment charges should be market determined or regulator prescribed, and how they can be made more transparent. Now, for instance, for funds transfer like your IMPS, RTGS and NEFT, RBI asks if charges should be prescribed or if there should be a cap on IMPS charges, etc. Debit cards, as you know, is the only merchant payment instrument where RBI has intervened to bring down charges, and here it is seeking feedback on whether regulatory intervention is required or if stakeholders can decide on an optimum level of MDR and interchange rate, and if RuPay debit cards should be treated any differently from the rest. MDR, as you know, is the fee that is paid by merchants to the banks for processing payments. Now, on credit cards, and this is important, RBI so far has not issued any mandate or intervened in the charges, even for PPI-based merchant payments or fund transfers. And this paper has sought feedback on this front as well. It has also sought feedback on, for instance, if people pay their credit card dues ahead of time, shouldn't that get reflected in lower MDR and their CIBIL scores, etc.? UPI is also under the scanner, where the government has mandated a zero-charge framework for such transactions. Now, this paper looks at general feedback in the context of zero UPI charges and asks if subsidizing cost is a more effective alternative, and if UPI transactions are indeed charged, should MDR for them be a percentage of the transaction value or a fixed amount, etc. It also looks at payment intermediaries in areas such as surcharge, convenience fee, etc. Now, while there's no real giveaway in terms of which way RBI is leaning, but if you do look at their payment vision document, affordability for customers and greater digital adoption is desirable. So unlikely that charges will go up significantly for customers. If they do, they might be borne by banks, fintechs, etc. But the impact on banks and payment companies because of these changes in charges will be significant to watch out for.
Okay, well, thanks a lot, Ritu. Taking that RBI discussion paper forward, our managing editor Shireen Wan spoke to Michael Maybach, the CEO of Mastercard, on the consultation paper and the BCCI sponsorship. Let's listen into some excerpts from that exclusive conversation.
So I just glanced over this morning. I find the thought process behind that and asking the kind of questions that were asked are the right kind of questions. They come to a point that I mentioned earlier. It's not just about the technology. It's about the broader ecosystem and the kind of questions that are being asked about commercial sustainability, because commercial sustainability often links into innovation. So I quite like that consultation process. So we will certainly be engaging with the RBI and say, here's our experience and what we've seen and what we think can work here in India.
You know, you mentioned where the puck goes
Right.
a couple of times in the course of the conversation. I thought you might say where the ball goes. Because rumor has it that you're going to be placing a pretty big bet on something that unites all Indians, cricket.
Right, the national passion. I heard about that rumor. Yes, yes.
Are you going to confirm that or not?
Well, so I say a few things. Sponsorships and passion, it's just something that works for us. The term priceless, you know, when you think about UEFA Champions League, there's so many priceless moments. In cricket, there's so many priceless moments, so it's just a natural fit to us. Whatever is a national pastime, we're always interested. So there's active interest, so we're engaging. It's a potential opportunity, but it is a potential opportunity. So that's about as much as I can say right now, but I'm very keen and interested on these kind of national sponsorship.
You follow cricket at all, though?
So I actually played this one time. The playing is probably the wrong word. I tried it one time. I lived in the Middle East for a long time, had a lot of Indian colleagues, and we went out to a cricket thing. And it struck me that it's weird to throw a ball on the floor because, like, I grew up with soccer. That's not what you do. But if you just see the lit up faces and the passion around the sport, it's just fascinating. So we want to be associated with it.
All right, interesting conversation. We'll get more excerpts through the day. As of now, we need to take a break. On the other side, Nisha Podar will be in conversation with Prashant Mehra, partner of Grant Thornton.
To Deal Tracker now, and the key highlights coming in for the month of July from the Deal Street is that there is a very steep decline of about 85% on a year-on-year basis for the month of July when it comes to the deal value. When it comes to the volumes, there is a decline, but still there were larger volumes of small ticket size deals, especially contributed by the startup as well as the IT space. And the larger share of the $2 billion worth of deal that is seen in the month have come in from the private equity contribution. Let's welcome on the show Prashant Mehra, who's the partner at Grant Thornton Bharat, to discuss more on the Deal Street views and the trajectory going forward. Prashant, always a pleasure to welcome you on CNBC TV18. And we quite a bit predicted that in our previous segments of Deal Tracker in terms of the slowdown on the Deal Street. Can you highlight what are the big reasons for companies really not taking any action when it comes to transactions?
Yeah, thank you, Shah, for having me. I mean, as you rightly mentioned, July 22 has been tepid as far as deal volumes and values are concerned, especially if you compare it to July 21. The reasons for that is some values haven't been disclosed, a few high-ticket ones in the July of previous year, and of course, some subdued activity as well. But if you look at the overall YTD trend, it is still positive. Private equity has remained at the same level in terms of values and volumes. M&A, there is still a steep increase of about almost 1.6 times. The reasons I would say, especially for the private equity, would be that it's a wait and watch. We were expecting a Fed rate increase in July, beginning August. That happened. For August also, with the RBI increase happened. I think everybody is adopting a very wait and watch and things to unravel before they take final decisions on closing deals. I would say that the next couple of months will probably be the same, but yes, towards the end of the calendar year, which is December, things will pick up because that's a closing for most part of the world, both from a domestic transactions as well as an international transaction perspective.
That's right. Some of the pending transactions may end before the mid-December holiday season in the West, Prashant. But at the moment, we are halfway through in the month of August. Is it still looking tepid? Where is the traction really coming in from? And what is the trend currently seen?
I think the last month also showed, two positive signs. One, we saw a transaction in the EdTech space, something that we had been waiting for quite some time, and we expecting that to happen. So that happened. We've seen some positive movement on the infrastructure side as well. Currently, there is a lot of traction in the tech sector, definitely, but also in the infrastructure sector. With the 15 days having passed in August, I would say the activity is still tepid. It would probably continue that. We won't see anything very significantly come in, but the evaluations would continue, specifically in the tech stroke infrastructure sector, and maybe some bits in banking, finance, fintech as well.
That's right. And in fact, ShipRocket just became a unicorn. Some good news coming in from the startup space currently. But how is the VC viewpoint and the foreign money, which was really giving that huge amount of thrust to the startup space? Is that really the trend that will happen or will see a resurgence? Or do you think consolidation in the tech startup space is going to be the theme?
I think a bit of both. As far as foreign money coming in, I think we've already seen that happen in the last fortnight or so, with the stock market now touching 60,000. So foreign FIIs have already started coming way back in. Yes, they're buying cheap and will sell at a high. And I think that's an indication that foreign money in terms of transaction will also start flowing in. As far as consolidation is concerned, which will drive M&A, that is flavor of the season and will continue for a while, and specifically in the tech industry. With the startups becoming unicorn, they would want to look at consolidations. With small startups which are not going anywhere, they're being looked at from a backward forward or a parallel integration by corporates. Because, I mean, let's face it, corporate balance sheets are still heavy. Besides everything, there is a lot of traction in the market happening. So both foreign money coming in and consolidation in the tech industry would continue. Closures may take a couple of months, but traction will definitely continue.
Right. And while we were talking, Prashant, we were also showing one of the Maruti Suzuki's new launch, Alto K10. That was really fascinating pictures from there. But my final question to you at the moment, of course, in this particular month, especially also given the thrust by Zomato, some of the private equity investors exiting like Blackstone in one of the auto components companies and some of the others that we have seen, is the window of opportunity in a little more euphoric public market that is being utilized by the private equity firms at the current moment. So probably the market transactions will increase the volume as well as value in the deal street. What else is there that you see picking up? And you spoke about consolidation. Any particular sectors in tech as well as digital which are showing more traction on that particular front?
I think edutech is something that we need to all watch out for. There will be more activity there. I think the other bit is anything around fintech. I don't know whether we want to put it in the financial services sector or we want to put it in the tech sector. It's a technology definitely is an enabler, so maybe a bit of both. So in the fintech sector, we will see. I mean, just before this, we were hearing some edits by RBI on their policies. I think that will drive a lot of transactions in the fintech sector.
Right. Thanks so much, Prashant, for giving your views on the deal street and a massive decline and a little bit of a slowdown that we have really experienced in the past month gone by. And that particular trend is likely to continue for a couple of more months, is the biggest takeaway that is coming in from Grant Thornton Bharat. With that, it's a short break on the show, but don't go anywhere. We'll focus on the commodity segment coming up on the other side of the break. Manisha Gupta will be joining us on the other side with Vandana Hari of Vanda Insights.
Welcome back and take a look at the crude oil prices, which have continued to be quite volatile, off the kind of lows that we started this week with, but we still are headed for nearly 5 to 6% of a weekly decline in this week itself. Well, this drop comes in as we have seen the markets look at Russia production increase. There are statements from Russia suggesting that they are looking at an earning from crude exports by nearly 38%. The reason that you're not at the lower point of the day also is because the IEA suggests that the US inventories have seen a big decline. Markets were anticipating a decline of around 1 million barrels. We saw a decline of 7 million barrels plus. And not just crude, the gasoline stocks also fell for a second straight week, and this time around by nearly 4.6 million barrels there. The gasoline production as well has been averaging lower from 10.2 million barrels in the previous week to 10 million barrels in this week. So we are looking at lower production, lower inventories, and that tells you that the demand clearly seems to be improving there. And that is exactly where the good news ends. The reason that you have seen a decline is because the supplies also seem to be increasing. The Russian output has been on the higher side. There is a lot of Asian buying for the Russian crude continuing to happen. And then you have the Saudi Aramco, Saudi Arabia, also saying that they can increase production to the maximum capacity of around nearly 12 million barrels per day. As of now, the Saudi Arabia exports already are hitting a 2-year highs now. The markets also are looking at the strength in US dollar index at about 106. That seems to be weighing onto the market. And then it is about the Iran nuclear deal. After 16 or 18 months of negotiation, there is some more concrete statements coming in for that one. There are 3 issues still needing to be resolved, and that needs to come in from US. But the expectation being that we are perhaps close to that resolve as well. And the final thing is about the UK inflation numbers that gained up by 10% in July, and again, highest since 1982. The Chinese demand is yet another factor here, where we have seen the numbers continue to decline. The Chinese refining for crude is at the lowest on a daily rate since the month of March 2020 at around 12.53 million barrels per day there. Take a look at the gas prices because they have continued to run up. We are trading at around 7-week highs when it comes to the Indian markets, and the international markets have continued to run up as well. Vandana Hari of Vanda Insights now joins us to talk about that. Vandana, hi, good to have you. Another week and another decline is what we are posting here, but we are looking at the US inventories, and that's a bit of a bullishness across all other fundamentals. How are you reading the numbers?
Good afternoon, Manisha. So it does seem that the U.S. inventory data, which showed quite a steep drop in crude stockpiles and a steep drop in gasoline stockpiles, was proved to be a bit of a bullish indicator for crude. But and also U.S. Gasoline demand, those numbers picked up as well. But in the big scheme of things, that effect may not last. And as we can already see today, crude prices have been trending down again.
Right.
And of course, before yesterday on 3 sessions, there's been a heavy sell-off. So I think the path of least resistance for crude remains downward for the time being.
All right. So how much downward are we anticipating? Because yes, the supplies do seem to be increasing from OPEC and otherwise.
So I think there's 2 scenarios that I can think of. One is whether the Iran deal restoration does proceed, in which case, the market is estimating we could see potentially 1 to 1.3 million barrels per day of additional oil from Iran coming onto the world market. If that happens, I think we could easily see Brent slip below 90. So a lot of the Iran deal, I feel, has already been factored in the sell-off in crude that we've seen in recent days, but not all of it, because clearly, we have to see whether the deal actually gets done and, what are the conditions that U.S. puts for removing the sanctions on Iranian exports. They may not be removed all in one go.
Right.
The other scenario is that the deal doesn't happen. But then, still there, I think there's plenty of downward pressure that will remain on crude because just generally the economic scenario, the demand scenario is not looking too good. The central banks are continuing to increase interest rates. And, inflation is starting to bite. Manufacturing activity is declining in all major economies. and the consumer sentiment is going downhill as well.
So what's your sense on where do we see next supports come in for crude prices? I mean, we've come off this year's highs quite consistently.
Yeah, so we have to remember that while it does seem that, there are reasons to be worried about global oil demand, and, there could be considerable softening in global consumption, and at least this quarter, the world could be in surplus as OPEC Plus is predicted. But we do have to keep in mind that there are just too many risks around supply, big risks. We have OPEC Plus still delivering close to 2.7, 2.8 million barrels per day below their target. There's not much spare capacity there. And then we are still in the midst of the U.S., the Atlantic hurricane season. So far, it has been quiet, but, the season doesn't reach its peak points until, I would say, end August or September. So the next few weeks could bring some nasty surprises on that front as well. So what I would say in terms of factors that could drive prices higher, keep an eye on unanticipated major production outages.
Point taken. Vandana, thank you as always for joining us there. So yes, there are concerns on both sides, but bearishness in crude prices is what really seems to be dominating the trend at this point in time. With that, that's all the time that we have on Halftime Report. Stay tuned for Business Lunch coming up next.